The more volatile the market is, meaning the more it's moving up and down or the more fearful it is, the higher this volatility number happens to be. And the higher the volatility number happens to be, the more we get paid to both agree to buy and sell our shares. Hey guys, Omar Khan here again at Theta Trading. I want to welcome you guys and thank you guys for listening to what we have to say, and hopefully we can shed some light on the world of investing for you. You guys could like, subscribe, and click on that bell icon for notifications. We'd greatly appreciate it. All right, so today's topic is volatility. What is volatility? We hear this concept every so often. You know, you watch the news, you're like, what is volatility? Well, volatility in the stock market means is how much is this thing moving around? It's going up, it's going down, it's going up, it's going down. This is the concept of volatility. And you're like, well, why the hell is this important to me? Well, this is important because here at Theta, we sell options, okay? And so we trade to invest, right? So we write naked puts, we sell covered calls, we sell naked puts and covered calls. Those words are synonymous. Why is volatility so important for us? Because volatility determines how much we get paid, okay? Now, I've mentioned this quote a few times, and I tend to do that because I want to hammer home some concepts, okay? Now, this is a quote from Warren Buffett that you probably heard me say a few times. When others are greedy, be fearful. When others are fearful, be greedy. What does this mean? Okay, well, what this means is that there is something called the volatility index. It is measured by something called the VIX, okay, or the VIX. Now, the VIX will tell you how nervous or jittery the market is. Basically, kind of like a fear gauge, okay? The higher this number happens to be, the more fearful the market is. And the more fearful the market is, the more greedy we're going to get. Now, the lower this number is, that means the more greedy the market is, which means the more fearful we're going to be, okay? Now, how does this relate to investing, though? What the hell? What does this mean? What does this mean to my investing? Okay, I'm going to give you an example of a stock, okay? Let's take a look at an example. I'm going to start from beginning to end. All right, let's take a look at Tesla. Tesla is a company that, you know, you start to see more and more electric cars on the road. You see the world is changing. I ask people about, hey, what car are you driving? What are you going to change? And I recently bought a Tesla myself. So not only do I see a lot of people changing to electrics and Teslas in specific, but I also see the world changing, you know, moving from gas to electric. So this is a big, big change for humanity. All right, so now that I know that, I've determined that Tesla is a stock that I want to be a part of, okay? Now, we've talked about this. Instead of just buying the stock, we prefer to sell a put or write a put to buy a stock, okay? Now, when you sell a put, you get paid a certain amount of money simply for agreeing to buy the stock. Now, today, Tesla's trading at about $670 a share. Now, if I believe long-term that Tesla will be worth substantially more than this because I've done my homework, I can see what's happening in the world, I'm not overly concerned about valuation because I'm a longer-term investor. Instead of buying Tesla for $670 today, I'm going to simply agree to buy Tesla for $670. I'm not going to actually buy it or $660 or whatever price I happen to pick. That is my choice. I can pick, you know, $670, $650, $620, $500 if I want. Now, that's called writing a put or selling a put, which means I'm agreeing to buy Tesla for a certain price for a certain period of time, and I get compensated for that, okay? But I'm going to go back to this case of Tesla. Tesla is currently at $670 a share. All right, say to myself, more than happy to pick up Tesla here for $670. I think it's going to be worth a lot more down the road. Okay, so we sell a put, okay? So let's say we sell a put for 30 days, which means we write or sell a put. It means we're agreeing to buy the stock for a period of 30 days, okay? So again, Tesla's at 670. I'm agreeing to buy it for 670. Now, in exchange for that, I'm being compensated a certain amount of money, okay? Now, where does the concept of volatility come in? Well, the more volatile the market is, meaning the more it's moving up and down or the more fearful it is, the higher this volatility number happens to be. And the higher the volatility number happens to be, the more we get paid to both agree to buy and sell our shares, okay? So when you look at put option premiums or call option premiums, one of the major determinants of pricing is volatility, okay? And that goes back to that Warren Buffett quote. So when volatility is high, we tend to be more aggressive. Now, what does that mean? Well, that means when others are fearful, volatility is high, we tend to be more aggressive. When volatility is low and when everyone's greedy, we tend to be less aggressive, which means we're not getting paid as much. So getting back to volatility and how do we take advantage of it? Well, volatility kind of does this, okay? Now, some stocks are more volatile than others. You'll find some stocks that have astronomical volatility. And you'll find some stocks like, your traditional banks or your utility companies, they'll have very little volatility. That means they don't move around a lot. So when you agree to buy them, well, you're not going to get paid a lot of money, right? But when you agree to buy one of those stocks that really bounce around a lot, wow, hey, you can make a lot of money simply for agreeing to buy that stock, okay? And again, one of the major determinants of how much we get paid is the concept of volatility. So the higher that number happens to be, the more we're getting paid, because that's the more fearful the market is. Let's look at a stock that doesn't move around a whole lot. Let's look at Coca-Cola, okay? Coca-Cola has been around so long that they used to put cocaine in the drinks. Now, you think of an energy drink, that is one hell of an energy drink. Can you imagine some guy in the 1800s or early 1900s drinking a can of Coca-Cola with cocaine in it? These new energy drinks don't have a whole lot on that one, but I digress. That's a whole different topic. Now, Coca-Cola, it's been around for a long time. It's pretty straightforward. Coke, Dasani water, bunch of other beverages. They're a bottling and distribution company. They're growing, but they're not growing a lot, which means what? The population of the world's growing. In fact, soft drink consumption is coming down, but they have other segments of their business. And what that means for Coke prices, it doesn't move around a lot. It kind of stays around that. It might move a little bit up and down, but it moves nowhere near the same amount as a company like Tesla. The difference is volatility. Tesla has a much higher volatility than does Coke. So when we agree to buy shares in Tesla, we get compensated far more than when we agree to buy shares in Coke. Why? Because of that concept called volatility. So here at Theta, as much as we are sellers of options, we are sellers of volatility. So when the markets are fearful and volatility is high, that is when we get more aggressive. And that is how you create large amounts of wealth over a longer period of time, right? So that is what we do day in and day out here at Theta. If you guys would like to find out more about this concept of volatility, selling puts, selling calls, all these concepts and how to put them all together. How do I make it work for me, right? How do I make it work for me? Well, take a look at our free 1-hour webinar and see if this is right for you. We're not here to pressure anyone. If you think this is good for you, great. If you don't, that's fine as well. All I can tell you, it has changed my life financially. It is, I didn't grow up with a lot of money. Fortunately, now I don't have to work ever again a day in my life, and it's been that way for a long time. And that's great. And why is that? It is because I have the knowledge. I am financially literate. I know how to create wealth for myself and my family. I'm no smarter than anyone else. The only difference is I understand concepts like volatility versus other people who don't understand. And this is one of the biggest failings of the education system is, people come out highly educated, but yet come out financially financially illiterate. We here at Theta are here to solve that problem of financial illiteracy. So anyways, guys, that's the concept of volatility, okay? The more volatile, the more a stock moves up and down, the higher the volatility, which means the more that we get paid when we agree to buy and sell these shares, okay? So that's the concept of volatility, and that's how we make a lot of money, simply by agreeing to buy or sell our shares for a certain price. So I hope you guys understand. If you have any questions or other subject matters that you'd like to learn more about, please comment below and let us know. Until next time, Omar Khan here from Theta. See you soon. Take care.